Hello, this is Connie Belden, and in this video, we are going to combine several of the exercises together to do some calculations here. So let's assume you're given the following information. Sales are 4,500 units or $135,000. And as we do this, we're going to fill it into a contribution margin format income statement. So I will fill in $135,000 for sales. Variable costs are $81,000. Now, to get the contribution margin, that is calculated by taking sales minus your variable cost. So 135,000 minus 81,000 gives you 54,000. And then it's also given that fixed costs are 48,000. So I will fill in 48,000. To get the net income, I will take my contribution margin of 54,000 and subtract out my fixed cost of 48,000. Giving me a net income or profit of $6,000. Now, we will use the information in this income statement to answer the rest of the questions. So let's start with question A. Question A wants you to compute the contribution margin, and this will be in total. We'll do it in per unit later when we do letter C. And to get the contribution margin as a ratio, that's as a percentage of sales. So I can actually do it as one formula here. When I take, as you see in my formula here, total sales minus total variable cost, that gives me my contribution margin, which actually did calculate in the income statement. So 135,000 in sales minus 81,000 in variable cost equals 54,000 as our total contribution margin. So I've done the first part of this formula to get contribution margin. Now I will take that contribution margin and divide it by sales to get it as a ratio. So I'll take my 54,000 and divide it by sales of 135,000. That gives me 0.4, or if I convert it to a percentage, a contribution margin ratio of 40%. So that means 40% of my sales are contribution margin. Now, the rest of that would have to be variable expenses. Let's go ahead and compute variable cost as a ratio. And again, that's computing as a ratio of sales. So the formula is pretty simple. I will take the variable cost divided by sales. And again, looking at my income statement, variable costs are 81,000, sales are 135,000. So 81,000 divided by 135,000 equals 0.6, or I will convert it to 60%. So for every sales dollar, 60% of it is a variable cost. The other 40% or 40 cents of every dollar is contribution margin. Okay, we got contribution margin in total at 54,000. Now we're going to get it as a per unit, as we use that to help us calculate break even. What is break even? Break even is where your net income is zero. You have no gain, you have no loss. So we're first of all going to get break even in units. How many units do we have to sell to have a zero profit? No income, no loss. Well, first of all, you do need to know the contribution margin per unit. Two different ways you can calculate that. We know the total contribution margin from Part A and from our income statement is 54,000. If we divide that by 4,500 units sold, that will give us that the contribution margin is $12 per unit. That is one way to get it. An alternative way is that we can give the sales price and variable cost per unit and then get the contribution margin per unit. So again, our income statement shows that sales are 135,000, and that was based on selling 4,500 units. So if I divide that out, $30 is a sales price per unit. When we look back at our income statement, the total variable cost is 81,000. If we divide that by the units sold of 4,500 units, that gives us a variable cost of $18 per unit. So now that we have the sales price of 30 and the variable cost of 18, we can subtract those and get the contribution margin per unit of 12. So in either case, we get the answer of $12 is our contribution margin per unit. Now, to solve for what it's asking for here, to solve for break even in how many units you have to sell, the formula is pretty simple. There are several of them, but this is the simplest formula. Take your fixed cost, which if we go back to our income statement was given at $48,000, and divide it by the $12 contribution margin per unit. When you do that, you come up with that to break even, you would have to sell 4,000 units. If you sell 4,000 units, you have no gain, no loss. You would have a zero profit. For question D, now that we have it in units, what is the break even in sales dollars? And again, a couple of different ways that you can calculate this. But since we know the break even is 4,000 units, one way that we could do that is we could take the break even in units, which is 4,000, and we calculated that the selling price per unit is $30. So 4,000 units times $30 means that the break even in sales dollars is $120,000. Okay, let's move on to question E. What if our fixed expenses went up by $2,400? Remember, they're $48,000 right now. What would the new break-even point be in units and sales dollars? So let's start with in units again. We will once again use the formula fixed costs divided by the contribution margin. But the fixed costs are going up. They were previously $48,000. We are going to add another $2,400 onto that. And then we will still divide it by the contribution margin per unit of 12. So our new fixed cost would be $50,400 when we add those together. Divide by 12. And our new break even in units would be 4,200 units. Now, to get that in sales dollars, we would take the new break even in units of 4,200 units. The sales price is still $30. Multiply that out. And the new break even in sales dollars is $126,000. Okay, let's move on to letter F. How many units must be sold next year to double the company's profits to $12,000? Remember, the net income is $6,000 in our current income statement. What if your boss says that's not good enough? How many units am I going to have to sell to get a $12,000 profit? Well, basically, we'll use the same formula that we did for break even, but we will add that desired profit into it. Okay, so fixed costs, we're going back to the original $48,000, plus your boss wants a desired profit of $12,000. We'll add that together and divide it by the contribution margin of 12. So that would be 60,000 divided by 12. Our new break even would be 5,000 units. And technically, I guess that wouldn't really be break even. That would be our new sales level because we would have a profit of 12,000. Okay, for the next one, we want to get that in sales dollars. So we will take that new amount of sales, 5,000 units, times the selling price is still $30. So that would mean sales would need to be $150,000 in order to get a profit of $12,000. Now, we won't do it here, but you could put any of those into an income statement to prove that you get a zero profit for break even or a $12,000 profit when you sell 5,000 units. Okay, let's move on to letter G. We're going back to our original data, so we're going back to fixed costs being $48,000. If variable costs went up by $2 per unit, we're going to determine, first of all, what is a new contribution margin per unit? Well, right now, the variable cost is 18 per unit. We calculated that earlier. So the new contribution margin would be the selling price minus variable cost, which it was previously 18. It's going to go up by 2. So that means variable cost instead of 18 would now be $20 a unit, giving you a new contribution margin per unit of $10. So now, what would be our new contribution margin ratio? Well, our contribution margin per unit is now $10. The selling price has not changed from $30. So that gives us a new contribution margin ratio of 0.3 or 30%. What would be the new break even in units? The fixed cost is $48,000. The new contribution margin per unit is $10. So if I divide that out, the new break even is you would have to sell 4,800 units. And part 4, what would be the break even in sales dollars? Well, you would take that new break even of 4,800 units. The selling price is still $30, so multiply it times 30. And that would give you a new break even of 144,000 in sales dollars. Okay, I'm going to pause it here at letter H, and I will continue with letter H in the next video.